The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Katie Greifeld, and standing next to me, hello, Scarlett Phil.
Hello. It's not even ETF IQ day.
It's not even a Monday.
All right. We're kicking you off to the closing bell here in the U.S. on this Tuesday. With stocks mixed right now, you do have the S&P 500 lower by 0.1%, but we're still pretty much near record highs. In terms of the gainers in this market, it's notable that you have the utilities, REITs, and materials, so more of the defensive sectors that are getting a little bit of a lift. You are seeing treasuries higher across the curve, so that means lower yields. The 10-year yield down almost 6 basis points to 4.14% after some weak retail sales data really bolstered the case for more Fed rate cuts. The U.S. dollar is under pressure. You definitely see it versus the Japanese yen right now, down 1% versus the yen at 154.32. And of course, we got to keep an eye on Bitcoin, Katie, after last week's roller coaster ride that took it to 60,000, now just below 69,000.
Yeah, can't look away from what's going on with digital gold there. But as you mentioned, some fluctuation when it comes to equity markets today as traders digest those retail sales figures, the first data set in a slew of economic numbers this week. December retail sales stalling to close out the holiday season with 8 of 13 retail categories actually posting declines. A sign, as Scarlett mentioned, that the Fed could make a case to cut rates again this year. We're going to get a better sense of that, though, with the January jobs report out tomorrow morning. But the CEO of Goldman Sachs, he's still confident in the U.S. economy. It says it remains poised for strong growth this year. Speaking at a conference in Florida, David Solomon called last week's steep drop in software stocks likely overdone, while he anticipates a speed bump this year due to AI uncertainty as well as geopolitics. He feels AI has the potential to create a recalibration.
We have software exposure, but I'd say it's insignificant in the scale of our overall platform, but it's certainly something that we're monitoring. I think the narrative over the last week has been a little bit too broad. There'll be winners and losers, and plenty of companies pivot and do just fine.
And as the AI story unfolds, so too does this earnings season. After the bell, we'll get big results out of Ford, Robinhood, Lyft, and Zillow. Big questions for Ford specifically, including how much those rolled back U.S. environmental regulations impacted the auto giant's top and bottom line. Maybe we'll get some answers in just about an hour, Scarlett.
We'll be all over those results. And while we focus, and rightfully so, on the big cap earnings, small caps are definitely having their moment when it comes to performance and earnings. In the past 6 months, the Russell 2000, which is the white line here, has rallied 21%, more than double the gain in the blue line, the S&P 500. And the fundamentals really back up the price action. The white dotted line here tracks bottom-up earnings revisions for the the Russell 2000's forward EPS, which is up about 17%. The blue dotted line, as you guessed it, is the forward EPS for big caps, revised up about 9%. And don't forget, Katie, if the Fed does end up cutting several times this year, that can be a more powerful catalyst for small caps, which, of course, do tend to be more levered.
All right, well, let's kick things off now with Neil Mukherjee, Chief Investment Officer over at TIAA Wealth Management. Neil, it's great to have you with us. So let's talk a little bit about what we're seeing in the small caps, because they fit into this broader rotation trade that we're seeing across size tiers, across, value versus growth, those sort of categories as well. How much would we be having this conversation had we not seen the AI trade kind of fall out of favor here?
Well, Katie, Scarlett, it's great to be with you. Thanks for having us. And, it's the AI trade is transforming from this momentum trade to a dispersion trade right now. And in 2025, investors were just politely asking the question about monetization. Now they seem to be demanding it. And it just seems like we've entered into this new era in the AI story where more and more of these applications, features, and plugins will be coming along, which will challenge traditional business models. Software is certainly the focus right now. It's under intense scrutiny. But I would actually push back on this narrative that the software business is permanently impaired. I think what you're going to see is that there's going to be more differentiation in this space. Fundamental players will step in. I will say that software sector has returned about 600% over the last 10 years. That's pretty good. And the valuation derating in the last couple of weeks, the last couple of months has been about 40%. So given that software is embedded into their clients' workflows in terms of integration, governance, maintenance, updating of key features, there will fundamental money will step in. But I do see the point here, which is there's a value rotation, there's a cyclical rotation that is happening in the marketplace. And I think that's predicated on the economic fundamentals.
Well, Neil, I'm glad you went to software because it's not just software, right? You also had insurance brokerage shares also seeing big declines. And then you take a look at one of the top stories on the Bloomberg terminal today, wealth management stocks sinking here as we fear the next casualty when it comes to AI. So, I mean, it sounds like software, you're not alone in saying that maybe this looks a little bit like an overreaction. When you think about some of the other sectors that have been caught up in some of these concerns, does that same logic still apply?
Yeah, I think we are entering into this age of disruption. We're entering into this phase where creative destruction will be happening at an accelerated pace. And like I said, you'll see more and more of these features and applications being launched. And when I think about industries or business models or even tasks and processes which are built on structured data and repetitive processes and work, that will increasingly be disrupted. So I think about professional services, legal services, financial analysis, data analytics, et cetera. There will be some rethink of these business models, but I do think that AI is going to be a force multiplier rather than a creative destruction element that everybody's factoring in right now.
Neil, I want to get your take on the data that we did get today. The retail sales report really disappointed a lot of investors who are looking for growth in the economy, evidence that the consumer remains resilient. Zero change in advanced retail sales for the month of December. In the control group, we actually saw a decline of 0.1%. How does this perhaps make us reassess the strength of the consumer and, you know, what the labor market might indicate about how the consumer spends going forward?
Well, Scarlett, the economic environment has been very confusing and the data has been messy for some time right now. What I will say is that we're in that unique moment in market history where tremendous secular forces are colliding with cyclical forces. Last year, you had the secular forces of AI investments, which papered over some of the weakness in the cyclical sectors of the economy, like weakness in housing, weakness in manufacturing, et cetera. At least this year, it looks like both of them are lining up in the same direction in a positive manner. We do expect consumer spending to be fairly healthy, fairly resilient. The wealth effects are going to power the spending of the high-income consumers. I think the low to middle-income consumers will benefit from elevated tax refunds. And then the AI investments that you've been covering for the last couple of weeks, $700 billion just by those four hyperscalers, that's going to add to GDP and productivity growth as well. You asked about the labor market. That is one of the weakest factors in the economy right now. We have to pay close attention to that. But I do feel that we're in this low hiring, low firing mode. And an important thing for investors to keep in mind is that the U.S. economy is transforming. It's going from an economy which has been powered by labor force growth to productivity-led growth. Generative AI adoption has been exponential, more than the PCs in the 1980s and the internet adoption of the 1990s. It's powering productivity growth at 2% over the last couple of years. That's above the 1.4% we saw pre-COVID. So that's good for GDP growth in 2026 and beyond, and it's good for inflation dynamics as well.
So we have the January jobs report that's coming out tomorrow. It's obviously delayed from last week. The consensus right now is for an addition of 65,000, but there's a whisper number of 40,000, which is considerably weaker than what the consensus estimate is and what we got in December as well. How is this market position heading into this important data point?
Yeah, it's a great question, Scarlett. I think the bond yield reaction in the bond market today is a reflection of some of the noise or some of the pronouncements that are coming out from the administration indicating the jobs number might be weaker. That comes out tomorrow. I think it also is a reflection of some of the other economic data that we're seeing, the retail sales we just talked about, the delinquencies which are going up for the low-income consumers. And some of this is really not new. We know that the labor market has been weakening for some time. It's a number of different things that are playing into it. It's the productivity improvements. It's the rationalization of the workforce. The tremendous amount of growth we saw in the workforce after COVID is now being rationalized. And it's also the impact of the low net immigration. So all of that is playing through right now. I would not be surprised that the narrative of a jobless expansion picks up more and more as the months go by.
Well, we'll see if tomorrow's data print sort of adds some more fire to that conversation. Neil, really appreciate you helping us to kick off the show. That is Neil Mukherjee, Chief Investment Officer over at TIAA Wealth Management. Now, coming up, The Close continues to be the place for the play-by-play breakdown when it comes to earnings. Up next, a conversation with the CEO of Quest Diagnostics on their latest report. This is The Close on Bloomberg. Shares of Quest Diagnostics hitting a record high after earnings this morning. The lab operator raising its dividend and issuing a higher than expected adjusted EPS forecast for 2026. I sat down with Quest Diagnostics CEO, Chairman, and President Jim Davis on the heels of that report. Here's part of that conversation.
We really think there's two or three major things going on. One, unfortunately, is still all of the chronic care disease management that's occurring in the country. You know, type 2 diabetes at an all-time high, autoimmune disorders, cancer rates, younger and younger patients being diagnosed with cancer, colon cancer in particular. So all of this is leading to a lot of testing, as you can imagine, and helping people diagnose, helping people figure out what the right therapy they should select, and then actually monitoring the disease. Now, at the other end of the spectrum, and this is really a more recent phenomenon, is all the new testing from a consumer health standpoint. So, you know, prevention is all about doing something before the symptoms set in. And between our own consumer health offering and then partnerships that we've developed in the industry, we are really powering the wellness industry today. So our relationships with Function Health, our relationships with Whoop, with Aura, we're trying to make lab testing ubiquitous to consumers, especially those that really have a focus on prevention and wellness. But really, it's those two things, Katie, that are really driving the growth.
Well, I'm glad you brought up consumer health and some of the partnerships you have, Whoop and Aura being some of them. You also have partnerships with Hims and Function Health, I see as well. How do you see that part of the business evolving? How meaningful of a growth driver can that be?
Yeah, so to put all of that in context between our own direct business, our own consumer direct business, plus our partnerships with all those that you mentioned, it's about a $250 million segment. And, you know, we did $11 billion last year. So it's meaningful. What's more meaningful is that segment grew at over 30% last year, and we expect it to continue to grow, north of 20% this year. And again, what we're seeing is just consumers taking more interest in their health with this notion of let's prevent disease. Let's try to get in front of that. You know, if we look at our business today, about 2/3 of it is diagnosis of disease, treatment of disease, treatment monitoring, and really only 1/3 of our business is prevention and wellness, general health and wellness testing. Honestly, I hope over the next decade we can flip that. I really hope that we can be 2/3 prevention and wellness and then 1/3 chronic care management.
When you zoom out a bit, what are you seeing in terms of trends when it comes to what types of tests are being asked for and ordered?
Yeah, Alzheimer's, Katie, is a very, very important set of tests that we now offer. You know, before blood-based biomarkers came to fruition with respect to Alzheimer's, the gold standard were cognitive tests that physicians perform, and then they would move that patient directly into imaging, whether that's a PET CT image or an MRI image. And today what we're seeing is there's blood-based biomarkers for amyloid plaque, for what we call these tau bundles. And you're actually going to detect Alzheimer's at a much earlier stage than what you would see in imaging. And some of the new therapies that have been brought to market by Eisai and by Lilly, these therapies generally work really, really well at the earliest stages of disease onset. So these biomarkers are playing a very, very important role today. We position these blood-based tests with primary care physicians as well as neurologists. Today, if you have symptoms of Alzheimer's, it can take upwards of 6 to 8 months to get in to see a memory care specialist. And patients just don't want to wait that long because, again, there's therapies available if you are diagnosed.
As you think about what's going on at some of your peer diagnostics companies, oncology testing has been driving just rapid growth. So how does Quest position itself in that space? I know that you recently bought Haystack Oncology, for example, but is that an area where you would consider additional deals?
Yeah. First, Katie, it's a very, very important part of our business today. Most people don't know, but Quest Diagnostics has a very large anatomical pathology business. Anatomical pathology is when specimens are cut from the human body. They're tissue samples. And so we have the largest anatomical pathology business in the country, where we make diagnoses of cancer every single day. Now, once you have that tumor specimen, there's several follow-on tests that are very important. The first being, what type of therapy should be used to treat that cancer after treatment or potentially right after surgery? The next question is, did the surgeon get it all, or did the chemotherapy eradicate that disease? And we have a test, you mentioned the Haystack minimally residual disease testing, that looks for very, very small remnants of the cancer that may remain either post-surgery or post-chemotherapy. So it's a growing portion of our portfolio of testing today. Now, in addition, we offer a lot of routine cancer tests, PSA screening, all sorts of different types of cancer markers at the screening phase. So all told, cancer, of our $11 billion portfolio today, cancer in its entirety is about $1 billion of our portfolio.
And our thanks again to Quest Diagnostics CEO, Chairman, and President Jim Davis. Now coming up, CVS also out with earnings this morning. Baird's Michael Ha joins us to help analyze my pen and paper interview with the CFO of CVS when we return. This is The Close on Bloomberg. It's time now for our top calls. Look at some of the big movers on the back of analyst recommendations. And first up, Take-Two Interactive. Raymond James taking the stock up to strong buy from Outperform and adding it to its current favorites list. The firm saying the sell-off is overdone and has created an attractive risk-reward for the Grand Theft Auto publishers. Shares a little bit. Oh, no, they're higher. There you go. Next in line, Vistra Energy. Jefferies upgrading the stock to buy from hold and boosting its price target to $203 from $191. The firm says that the market is undervaluing future data center deals and sees an attractive risk reward as a result. And finally, Under Armour. Citi cutting the athletic apparel maker to sell from neutral and maintaining its $6.20 price target. The firm citing a highly competitive environment, underwhelming traffic in its direct-to-consumer business, and caution in non-U.S. markets. Shares down nearly 9%. And those are some of our top calls. Meanwhile, we're also keeping an eye on shares of CVS, really fluctuating after this morning's earnings report. I sat down with CFO Brian Newman earlier, who told me that the company is, quote, committed to Aetna margins and that the margin recovery in that business remains unchanged even into 2027. Joining us to unpack it all live is Michael Ha. He is senior research analyst over at Baird, covering managed care and healthcare facilities. So specifically, that Aetna's quote was in relation to Medicare Advantage rates. The news coming at the end of last month was that CMS is going to hold those rates pretty much flat when it comes to 2027. Obviously, that took a big chunk out of insurers, including CVS. In light of that, and in light of the earnings that we got this morning, how are you thinking about CVS at this moment?
Right, and thank you for having me. So we're outperform on CVS, but the story, which was a very clean narrative before, has much more nuance to it, and it's less clean, and primarily because of the Medicare Advantage rate notice that we're about to dive into. Fourth quarter alone, perfectly fine. 2026, still on track to be a good growth year, but because of the 2027 advanced Medicare rate notice that's unfavorable, now it puts CVS in a very difficult spot where, we tend to disagree and think that the path to growth in 27 feels more challenged. They're targeting mid-teens EPS CAGR through 2028, but remember, half of that growth is essentially Medicare Advantage, and if they're unable to expand margins, then that materially impairs their trajectory.
Yeah, that's definitely a big question mark, a big cloud hanging over the company. Once upon a time, CVS was a pharmacy, and then it became a pharmacy with a PBM, and now it's a vertically integrated healthcare giant. Who then is its closest competitor, and therefore who is it compared against operationally and in terms of valuation?
Great question. I mean, vertically integrated models are now the standard for managed care, United Health being the holy grail, which we're actually underperform rated on. But I would say in terms of pharmacies, Rite Aid, Walgreens, clearly they've seen a lot of pressure. And I think that's been a contributor to why their pharmacy business has outperformed this year, which has been actually a surprising bright light for the company.
Yeah, absolutely. And they're expecting at least 1% growth in 2026 when it comes to the retail pharmacy. I want to talk a little bit more about 2027, though, especially as it relates to Medicare Advantage, because a point that the CFO made to me is that, the medical cost trends that they're seeing, they don't align with what CMS necessarily sees, and they're submitting comments on basically that, and they're hoping that maybe that sways the discussion. Do you think there's any chance that we could see those payment rate numbers that we got at the end of January change by April or so?
We do. We do think they'll improve, but likely not enough. We're expecting about 100, 150 basis points of improvement, but that's off of flat. Remember, cost trends are running high single digit. United was out there saying 10% Medicare Advantage trends. So how do you bridge the gap from 1% to 2% rates potentially and 10% trends? And that's why heading into 2027, we believe for CVS and most Medicare Advantage plans, it might be a knife fight to keep margins flat and protecting margins rather than what we thought was going to be a beautiful MA trade design, expanding up margins.
I'm guessing CVS won't be the only company making that argument, though, right? Will it be more convincing for CMS to hear that from several companies?
Right. I believe essentially all Medicare Advantage plans will be making that case because, quite frankly, it is true, and it also puts a positive light on models that actually do bend the cost curve. Our top pick, Alignment Health, is one that I believe does bend the cost curve in a meaningful way, and it could be an actual advantage for them from a relative positioning.
All right, Michael, thank you so much for joining us today. Really appreciate your coming in. Michael Ha is Senior Research Analyst at Baird. He covers managed care and healthcare facilities. Coming up on The Close, we're going to get to the heart of what's keeping life sciences under pressure with Becton Dickinson CEO, Chairman, and President Tom Polen. That's coming up. This is The Close on Bloomberg.
Just about 3:30 p.m. in New York. This is the countdown to the close. I'm Katie Greifeld.
And I'm Scarlett Fu. Earnings season is in full swing. We've gone past the tech phase of it. We're heading into the consumer phase. We're definitely more than halfway through. And so far, the numbers, as always, are pretty good. If you look at the number of companies that have beat estimates, 78.4% of the S&P 500, that's the yellow bar on the far right. That's actually down from the last couple of quarters, but given that the low bar here is 74.5%, we're still talking more than 3 out of 4 companies.
I feel like that's a neatest asterisk there when we talk about the low bar. It is interesting that that low point came also in the fourth quarter here. So we'll see if, of course, this year sort of follows a similar pattern where those beat rates get even higher as we progress deeper into 2026. The market reaction, though, it was interesting, especially with the big tech names. It felt kind of hot and cold in terms of the reception. But it'll be interesting, as you say, as we get deeper into some of these consumer names, these consumer-facing names, whether that changes.
Absolutely. I mean, for big tech, it was all about the CapEx and, the tone in how they talked about the CapEx. So certainly that's a different story with the consumer names, which is just about getting through this period. We also, of course, have medtech giant Becton Dickinson and Company as one of the companies out with results this week. Joining us now is CEO, Chairman, and President Tom Polen, and he joins us here in office. Great to see you.
Thank you for having me.
Thank you so much for coming in. So just give us a sense of what you saw over the quarter that ended and how that positions you for 2026.
Sure. We had a very strong quarter. Both revenue and EPS were ahead of our expectations. This is our first quarter, so strong start to the year. The other big thing that we announced yesterday is we closed a merger with Waters for our life science business. That's a transaction that we announced in July, and the first ever reverse Morris trust in the life science med tech space. So a big milestone. And what that did is it launched the new BD as a focused med tech company and created a new leader in the life science space.
So how do you plan to renew your focus on the remaining segments following the divestiture of that diagnostic business to Waters?
So that divestiture was actually the culmination of 3 major divestitures that we've done over the last 3 years, reshaping our portfolio. We've also done about 20 tuck-in acquisitions over that same period of time, really focus on positioning BD to align with some of the fastest growing trends reshaping healthcare. That's the use of AI, robotics, and informatics to improve the cost and quality of care, technologies that help care move from the hospital into the home, and technologies that help improve outcomes for patients with chronic disease. That's what the new BD is focused on, and we're doing that based on a foundation where we make 35 billion medical devices a year. We touch 9 out of 10 people walking into a hospital. We're the market leader in 90% of the markets in which we compete, and we're taking that long-standing expertise and touch points with our customers to help them transform for the next era of healthcare. And it's an extremely exciting time.
Well, you talk about the new BD, and I mean, just to run through some of what you just said. So, okay, you've got the divestitures out of the way. You've done about 20 tuck-in acquisitions during that time. Are you happy with sort of the business portfolio as it stands, or do you have any more plans along those lines?
We're going to continue to invest behind those areas. So, for example, we've positioned ourselves as, when it comes to moving care to the home, when it comes to delivering biologics, we, for example, are the leader in delivering GLP-1s. Billion doses of GLP-1s delivered with our devices last year. We're really excited about that space. We're going to continue to invest in it. Areas like automation, robotics for the pharmacy. We're a leader in it. We're going to continue to invest in that. We're in the right spaces. It's now about executing and continuing to invest.
I'm glad you brought up GLP-1s because that is definitely a fascinating story. And we know that Novo has their pill out. We know that Eli Lilly not too far behind. It seems like injectables, of course, have been a big business for you. This move into pills, these oral GLP-1s, how might that affect the business?
I think most people view that as complementary to the space. If you look at where pharma's investing, they're still investing billions of dollars in expanding injectable capacity. Also, as you think about the next classes of GLP-1s, they're coming with not only weight loss, but protecting the muscle. So you're going to have people who are not only losing weight, but could be gaining muscle at the same time. Those are all injectables when you look at those next level benefits.
Now that you've completed this transaction with Waters, how do you plan to use the $4 billion in proceeds?
So we announced yesterday we're going to take $2 billion of it. We're going to pay down debt, continue to strengthen our balance sheet. We're going to take the other $2 billion, and we just kicked off an ASR to buy back $2 billion of shares. So returning value to shareholders in an appropriate way and setting up the company for long-term success.
And in terms of the mid to single digit growth target for revenue, I guess my question here is that you had given guidance for low single digit growth for fiscal 2026. What's the bridge back to that?
Yeah, so we're working through some near-term dynamics. One would be vaccines. We do see vaccine utilization down this year. You can see it. Less people got flu testing. Most of vaccines are delivered on our devices, so we saw a reset this year, which we incorporated in our guidance. Same thing, we saw some pricing dynamics in China that we built into our guidance, and then a dynamic of having success upgrading one of our products. It just creates a grow over. As those things work their way through over the next 18 months, we see us returning back to that mid-single digit growth profile.
Let's talk about some of your product portfolio. We already talked about syringes, of course, but when it comes to maybe some higher growth products, I mean, our Bloomberg intelligence analysts have talked about maybe some higher tech products that could help in that transition. Just walk us through, where that stands and, how that could expand in 2026.
Sure. So we bought advanced patient monitoring business last year that's using AI to predict what could happen to a patient in the future. So rather than wait for your blood pressure to drop, we're projecting this could happen 15 minutes from now in the patient. Let's adjust therapy to keep them safe and keep them in line. That would be an example. Pharmacy robotics would be an example. We have a $700 million pharmacy robotics business that's helping to enable, for example, online pharmacies that are shipping to your home. All of that's being done behind the scenes with our robots. As you think about advancing chronic disease, areas like urinary incontinence with our PureWick product, treating peripheral vascular disease, reconstructing tissue. You don't need plastic hernia mesh in your body anymore. Some of our technologies allow that to be bioabsorbed in 18 months and have nothing left behind. Those areas are all growing double digits for us and continue to be areas that we're investing in new applications and indications for.
All right, so a lot to work on there, firing on all cylinders.
Yes.
Tom, thank you so much for joining us. Tom Polen is Becton Dickinson CEO, Chairman, and President, joining us in studio today. You mentioned Novo Nordisk.
I did.
There's a big conversation coming up.
Yeah, speaking to the CEO of Novo Nordisk, Mike Dostar, tomorrow, of course, this follows a very turbulent week for Novo Nordisk. We know, of course, they pre-announced their earnings. Those sort of landed like a wet balloon. And then a lot of drama. Legal drama with Hims and Hers. Hims and Hers announcing basically a knockoff of their new Wegovy oral pill that we were talking about. They've since abandoned that. Now Novo is suing him, so it's going to be interesting to get an update there. But definitely a lot to talk about when it comes to just the overall GLP-1 space. We talk about AI disruption all the time, but when you think about just the health industry overall, GLP-1s, this weight loss category, definitely has been sort of the AI moment for healthcare.
Absolutely. You've been making that comparison for a while now, and it feels like the oral GLP-1 is also even more of a disruption on the injectable GLP-1.
Yeah, it's going to be interesting. I mean, both companies, obviously, they've made a cash cow over the injectables. They're hoping that it will be complementary, like we were talking about, that it'll be more expanding the total addressable market than cannibalizing. But of course, we're just going to have to wait and see there.
Coming up, Spotify's latest earnings report seems to be music to investors' ears. Spotify is today's stock of the hour, and that's coming up next. This is The Close on Bloomberg. It's time now for our stock of the hour. Spotify striking a chord with investors, with the share soaring following its latest earnings report. The music streaming platform added a record number of new users last quarter. Joining us now is our markets correspondent, Norah Mulinda. So it's as simple as the record number of new subscribers?
Essentially, that's what everyone is very optimistic about. So we did see that the company was essentially citing its Wrapped, Spotify Wrapped, if you guys are familiar.
Oh, yeah.
End of the year. It curates, shows a list of your top songs of 2025 or whatever year we're talking about. And apparently it's just a hit. I mean, I'll talk from like a personal anecdote.
Who's
I love
your top
Spotify
artist?
Wrapped. Justin Bieber.
No, stop
Every
it.
year.
In the year of our Lord, 2025.
In the year of our Lord.
Wow, God bless.
2026.
Scarlett, do you have a Spotify?
I didn't check it for the end of 2025.
Really?
So, yeah.
What would you assume it would be?
Oh, God. I mean, I listen to a lot of old stuff, so probably New Order.
We're going to check this in the commercial break. Mine was My Chemical Romance. But anyway, okay.
That tracks.
Yeah, so that
Thank you.
definitely is what they did see spurring some positivity. But additionally, they did launch the enhanced free tier for Spotify as well. So they're saying that those are two things that really drew a lot of new users. If you do recall, we had the CEO, the founder, that stepped down. So we have two co-CEOs that have come in. So this earnings report, of course, is still based off of the founder and CEO, the former CEO rather. And this is going to be interesting to see how things look moving forward. But there's also been a lot of intention, no surprise, on artificial intelligence.
Right.
That's what we saw so many questions about on the earnings call. A lot of people were asking about how they're going to better utilize artificial intelligence moving forward. So a lot of scrutiny, a lot of eyes on these new two CEOs, co-CEOs coming in here to see what they're able to do. They do have the artificial intelligence DJ function, which if I'm not mistaken, Apple has as well. So curious to see how they'll continue to curate and make things more personalized for users.
Is that the one where you tell them a bunch of things, you tell AI some stuff, and they come up with a playlist for you, or some?
So they have that as well.
Okay.
So that's separate. That's called the promoted playlist. But separate to that, they also have an AI DJ function. So instead of hiring a DJ, you just hit the function.
I haven't been that impressed, honestly. I used it a few times, and it was just like playing my repeated songs. So, it didn't impress me too much. The co-CEO model is interesting. Going to be fun to follow how that plays out. When it comes to Spotify, I mean, you mentioned Apple Music a few different times. Who exactly are their peers when it comes to, a stock comparison? Because, I mean, you just take a look at the stock of Apple. That's not necessarily trading on Apple Music necessarily.
Right. And that's what's really difficult here when we think about publicly traded peers here, because Apple Music, Amazon Music, some people use that. We also have YouTube that people go to listen to music. We know that's attached to Alphabet, Google. So a lot of these other companies that we could be comparing it against, their core product isn't music. So Spotify, of course, is that, Pandora. That's something that people still continue to use. So that's kind of the landscape right now. But for Spotify in particular, people are just really looking for that growth story, especially given the fact that a lot of these other competitors are a lot more diversified.
I guess it's pretty impressive that they added 38 million new listeners, especially when they raised prices in the U.S. And it feels like there's still room for them to do that, according to analysts.
That's what I'm hearing from analysts and sources. But I also think that a lot of people have a sort of loyalty when it comes to Spotify. It's a rivalry between Spotify Music and Apple Music for most people, in the same way that it's a rivalry between an Apple iPhone and an Android. So a lot of loyalists when you think about Spotify. So we'll see if they were to raise prices. I do imagine that a lot of people would still stick with it.
I would just keep paying it. I mean, I feel like I've had it since like 2011, 2012. Where am I going to go?
You just got to renew.
Yeah, come on.
You don't want to rebuild your playlist, right?
No, I have, a whole identity there. Anyway, Norah, Mulinda, great reporting as always. Of course, a banner day for Spotify. Coming up, though, we're going to take a look at these broader markets. We'll take you to the closing bell with Kevin Gordon. He is head of macro research and strategy over at the Schwab Center for Financial Research. That conversation up next. This is The Close.
The U.S. economy is transforming. It's going from an economy which has been powered by labor force growth to productivity-led growth. Generative AI adoption has been exponential. It's powering productivity growth at 2% over the last couple of years. That's above the 1.4% we saw pre-COVID. So that's good for GDP growth in 2026 and beyond.
That was Neil Mukherjee. He is Chief Investment Officer over at TIAA Wealth Management, kicking off the show, Scarlet Fu. And if you take a look at where we're going to finish out the day, sort of an uninspiring end to this Tuesday, right?
Yeah, there's not a whole lot of conviction, at least when it comes to equities. But I guess it's not a huge surprise, given that the Dow closed at a record high, the S&P 500 still holding near record highs.
The Dow is banned this week.
The Dow's banned, really?
Yeah, we can't talk about it.
But it's above 50,000, you know?
I know, but it's a price-weighted index of like a couple
of record high is a record high. Nonetheless, there is conviction in the bond market because you definitely see yields moving lower, and it comes before a big jobs report tomorrow.
Yeah, it's going to be interesting to get those delayed numbers, delayed by just about a week. Did we really need that? But certainly the number itself is going to be important, as to are the revisions. So a lot to look forward to tomorrow. But let's keep the conversation going now with Kevin Gordon. He is head of macro research and strategy over at the Schwab Center for Financial Research, joining us on set. It's great to see you, Kevin.
Good to see you guys. Thanks for having me.
So let's talk about the state of the trade, because you point out in your notes that we've seen a rally without tech leadership, which is really interesting, that we're hovering near these all-time highs on the S&P 500, even though it's been a less than stunning performance from some of your mega cap tech names. But if we do see this sort of dynamic continue, we do have this broadening out, does that just translate into less stunning index gains that we've gotten used to over the past couple of years?
Yeah, it's just less exciting. I mean, if you look at even the past 3 to 4 months for the S&P, it's been this grind higher, but a really slow grind, and it's really just as you pointed out. The index math kind of works against you at this point. If you do see a majority of sectors that are rallying, which has been the case, underlying breadth has actually been pretty strong, and it has been strengthening. If you look at the percentage of companies in the NYSE universe that are above their 200-day moving average, you're at 2/3. That's been grinding higher over the past several months. But because of the absence of that tech leadership, I would also throw in communication services and consumer discretionary. Those three sectors make up 55% of the S&P 500's market cap. So if you don't have those participating as much, and if they're not leading, the index math just works against you in a cap-weighted index. So that's why there's been such a significant reversal in terms of the cap-weighted, equal-weighted relationship for the S&P. But also, it's not just within the large cap space; it's extended down to small caps too, and that's continue to have legs, which we think has been a little bit of a different factor, or a little bit of a different perspective than you've had in prior instances where equal weighted has tried to make a run relative to cap weight.
Yeah, it's been interesting to keep track of these different indexes. I mean, equal weighted, I believe it hit a record yesterday. The Russell 2000 not too far away. But let's talk about the state of the tech trade, because we were having a conversation with Robert Schiffman over at Bloomberg Intelligence yesterday, who made the good point that you take a look at this bond issuance coming from the big tech names. Bond investors can't get enough. This is being getting a warm reception by the bond market, which is different than how equity investors have been treating, of course, this spending and this issuance. And I wonder, who you think is right in this situation?
Well, I think, just the look at a lot of these mega caps, because those are the ones that have been in focus in terms of what's going on in the bond market and all that issue. And so I do think that it stresses the importance of a lot of fundamentals and higher quality aspects to the tech sector today versus what it gets compared to a lot, which is in the 90s or the late 90s or the early 2000s. So to me, there's an important distinction there. And I think we have to keep in mind, it's not as if the earnings profile for the tech sector has turned decisively negative or is in a dire state for this year. It's just that differentials are starting to favor other parts of the market and other sectors that just haven't participated. And you can sort of put it in two groups where it's deeper cyclicals that are probably keying off of some reacceleration in parts of the U.S. economy. I would point to manufacturing data looking a little bit better on the margin, but then also some of the forgotten sectors like healthcare or even staples to some extent. To me, that's a little bit more of a catch-up trade than it is some sort of fundamental belief that defensives are going to rally and lead us. So I think all of those aspects, tech still being relatively healthy from a fundamental standpoint, but also other parts of the economy now starting to kick up a little bit, I think those are all, sort of dually at play.
It's just that everything we're hearing from tech kind of backs up the price action we've already seen thus far. When it comes to those consumer staples and other consumer companies, that's the phase of earnings we're in right now. What do you expect to hear? What do you expect to learn from these companies, and how does it inform your sense of where the economy is?
I think a lot of it comes down to how much more margin pressure is there, especially from tariffs, and what's the expectation that there's going to be more of a hit, because staples have been, traditionally they're in a weaker spot when it comes to margins. So when you think about, profit margins having been such a strong performer when it comes to factors in the market, especially the S&P 500, that to us is what we're looking for. If there's any kind of notes or hints of improvement at the margin, because the market's going to key off of those changes, not necessarily the level. So that rate of change really matters, and I think that's probably a reason why you're starting to see some of the staples, trade get some wind, behind it. I would say the differential between the cap-weighted and the equal-weighted really needs to be looked at, because the largest company in the cap-weighted staples sector, which is Walmart, had been, rallying in a pretty strong way. So, to the extent that gets mirrored down the cap spectrum in that index, I think that needs to be looked at. Not the case for something like industrials or energy, where those equal-weighted indexes have been rallying as well.
A lot of those cyclicals obviously are also exposed to overseas sales, and we've seen a weaker dollar. That has been a consistent theme throughout this. Whether people are gravitating towards, Bitcoin or something else is another matter entirely. For that cyclical group that relies on overseas sales, how much of a tailwind is that weaker dollar?
I think it's definitely a tailwind, but I don't think it's the tailwind, because you look at the two sectors that do dominate when it comes to overseas sales, in terms of their share, and it actually is tech and materials. Two completely different, performance profiles over the past month. So I think it's definitely additive, but I think it matters a lot more for ex-US performance than it does for an index like the S&P or the Dow. I will still mention the Dow, but I think when you compare the two, to me, it's much more of a Europe and Asia story as opposed to a sector story within the United States.
Well, Kevin, you know the rules. You mentioned the Dow, so we have to say goodbye. But come back soon. Great conversation.
Nice to be here.
That is Kevin Gordon. He is head of macro research and strategy over at the Schwab Center for Financial Research. A really interesting point on the dollar here, Scarlett. It's not going to be the driver, but certainly a driver. And you take a look at the BBDXY over the past year or so, the trend is clear here.
Absolutely. Even though the administration, like every other administration, says that they have a strong dollar policy, that's not backed up by what the president is regularly pushing for. He wants to win when it comes to exports.
Yeah, absolutely. So we'll see what sort of stops the slide there. Meanwhile, you take a look at where we are at the index level on these equities, a bit of a fade into the close here.
Yeah, we're definitely at session lows right now for all the major indexes. I mean, the Dow's still clinging on to gain, but you don't care about that. Louise. So we'll focus on the NASDAQ, which is down by 0.6%. Even the Russell 2000 of small cap stocks lower by 0.4%. And it's been outperforming.
We're going to unpack all the action right now as we move closer to these closing bells. Full market coverage right here with our global simulcast.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And about 2 minutes away from the end of the trading day, Katie Greifeld here with Scarlett Fu. Romain Bostic out on assignment. And here to help take us through the closing bell, we're joined now by a global simulcast. Carol Massar and Tim Stenovic. We bring together all of our different audiences right now, television, radio, YouTube, count the ways, Carol. And it seems like we're going to finish out on the lows of the session.
Yeah, we're actually just in these final few minutes of trading, we're seeing another leg down on the major equity averages. Funny, in a day where we actually saw the S&P on an intraday basis hit another record high, but that's not to be. I don't know whether maybe investors getting a little nervous about tomorrow's jobs report.
That's that why Bitcoin's moving lower?
Well, you tell us.
So we're actually, for much of the last few days, we were just hovering around $70,000. But Scarlett, we seem to have fallen from that. Bitcoin down 68,750 roughly right now.
Bitcoin is not really correlated with any asset beyond risky assets in general. So we're told, yes, absolutely. What's also notable, I should mention too, is that volume is lower. Volume in the S&P 500, for instance, off 15% from the 10-day average. So I don't know how much you can read to the fact that we have hit our session lows right now.
Yeah, that's the thing. I mean, it kind of feels like we're in a wait and see sort of moment on this Tuesday. We got some data this morning. The big report, of course, is tomorrow, Carol, when it comes to that jobs report, not just the numbers themselves, but also the revisions closely watched.
Yeah, it's the Fed dual mandate this week. We get jobs tomorrow, and then, of course, we get inflation on Friday. So we'll see what it means in terms of what it says about the U.S. economy.
Meanwhile, you hear the bells ringing right now as we close out the session on this Tuesday. The S&P 500, as I mentioned, going to finish not quite at its lows of the session, but pretty close, down about 0.4%, depending on the second. The NASDAQ down about 0.6%. The Dow, for whatever reason, higher by about 0.1%. How much can you read into it? It has just 30 members, and again, it's price weighted, but nevertheless, we like to look at it. Meanwhile, you take a look at the small caps. I believe they're on that screen next to what we're looking at right now, sort of fitting in with the broader action as well, Carol.
Yeah, just taking a quick check at the Russell 2000, down about 1/3%, so definitely off its highs of this session. Having said that, Scarlett, you've got most names actually the S&P 500. The big caps higher today, about 301, 200 to the downside, and 3 unchanged.
All right, so let's take a look at the IMAP, or the circle, as Katie likes to call it.
Thank you.
We do have utilities, one of the smaller sectors in the S&P 500, leading gains up 1.6%. Real estate investment trust up 1.4%. Materials gaining 1.3%. These are not big, weighty, influential sectors in the market. Healthcare, commercial communication services, and financials are the leading decliners, and that's why most of the pie is red. I call it a pie.
Matt did too.
It does look like a pie, a red pie. Let's go to some of the individual gainers, because I had a pretty good list to choose from. Let's go to the number one gainer in the S&P 500 and the NASDAQ 100. We're talking about Datadog, ticker DDOG. Software company's fourth quarter results beat expectations on key metrics. It also gave a full year forecast that was weaker than expected, but analysts see it as somewhat conservative. Keep in mind that this stock is one of many stocks that have gotten caught up in a broad-based sell-off of software names. It's down more than 40% from its November peak, but some bounce back today. Again, just up shy of a 14% gain today. Let's go on over to Spotify. A lot of folks talking about Spotify here at Bloomberg today. At its high, up almost 20%, finishing the day with a gain of almost 15% here. I believe it's the biggest intraday gain, and I'm not sure about the close here. I have to look at that, since about 2018. So we haven't seen this move in a long time for this name. The company, the music streaming giant, added a record number of users last quarter, far surpassing analyst expectations. So adding some 38 million new listeners from October through December to reach 751 million, according to a statement today. And the company crediting its annual Wrapped campaign. But I heard that it didn't actually work for Tim.
It definitely didn't.
It said that you actually were...
I can't remember exactly what it said, but it was just...
What did it say?
It said like... I
that he listened to music of old people?
That's me, so we're in cahoots together.
It's just, if you go and look at my top songs, it's like,
It doesn't track? It doesn't
track, yeah. It's very, very strange.
Fleetwood Mac, Beatles.
No, and I love that stuff. I love that stuff, but it's like, it's a lot of Bon Iver.
Maybe you learned something about yourself, You gotta be open to this stuff.
Embrace it, Tim. Yeah. It's okay. We still love you. All right. And now for something completely different. It's a good thing Romain isn't here because he'd probably make fun of me. Small cap space. We're talking about European Wax Center. We don't talk about this a lot. It's a $312 million market cap company, surging 43%, so pretty much finishing at its best levels of the session. Company agreed to be taken private by General Atlantic. It's an all-cash transaction, and it valued the company at approximately $330 million, and the stock now up about 60% year to date. All right, over to you.
Okay.
Fan of 50, 60-year-old.
Let's start with what's going on with Alphabet, ticker GOOGL. This was one of the biggest weights in the S&P 500, down 1.8%. I wanted to take a look at this after Alphabet had raised almost $32 billion in debt in less than 24 hours. What it does is it shows all the funding needs that tech giants have, and they're competing to build out these AI capabilities. The company sold sterling and Swiss franc dominated offerings, both of which were the biggest ever corporate bond sales in their respective markets, demand being high across those deals. And it does come after Alphabet said its CapEx will reach as much as $185 billion this year. So $32 billion in 24 hours, kind of a small drop in the bucket in terms of total CapEx that will be spent this year, but meaningful nonetheless. Also, shares of Coca-Cola declining on the day today. The company gave a full year outlook for 2026 that saw organic sales growth, or sees organic sales growth at 4 to 5%. That's just slightly less than what analysts wanted to see. It's a little more conservative. There are some challenges winning over shoppers with portfolio of beverages. Consumers are switching away from traditional full-calorie Coca-Cola toward healthier options. The company sees momentum in some markets and challenges in other markets. The World Cup expected to boost sales in Mexico, which is hiking a tax on sugary drinks. And finally, this is really interesting. Wealth management firms today took a hit. They turned lower after Altruist launched a new tax planning offering within Hazel, its AI platform. So look at this. Charles Schwab down 7.4%. Raymond James down 8.8%, Katie.
Meanwhile, let's get quickly over to Ford earnings, just crossing the wire here. When it comes to the fourth quarter, adjusted EPS coming in at 13 cents. The estimate had been for 18 cents. Meanwhile, you take a look at 2026 adjusted EBIT, seen between $8 billion to $10 billion. The estimate had been for $8.86 billion. So the midpoint of that range ahead of the estimate here. You can see shares trying to decide what to do. Of course, Ford has been on a tear when it comes to the stock performance as of late. It's going to be interesting to dig a little bit deeper into these earnings. We remember, of course, that Ford has been significantly scaling back on EVs. We're starting to get more commentary out of the company soon.
All right, we also have earnings out of Robinhood, and that stock is plunging in the after-hours trade right now, losing about 7%. This is after its fourth quarter net revenue missed analyst estimates. $1.28 billion was the print. Analysts were looking for $1.35 billion. Fourth quarter adjusted EBITDA was $761 million, also lighter than the anticipated $833 million. In addition, fourth quarter average revenue per user, ARPU, was $191. Analysts were looking for something above $200. So again, the stock losing ground right now, off by 6.25% in after-hours trade.
All right, Scarlett, we've got another name losing ground in the aftermarket, and that is Lyft. And that's despite authorizing a new share buyback up to $1 billion. But let's go to the outlook, because that's probably what has investors a little upset here. Lyft seeing first quarter adjusted EBITDA of about $120 to $140 million. So it looks like they're reducing some of the range, a lower range. The estimate on the street is at that $140.5 million. As for the first quarter, in terms of gross bookings, about $4.86 billion to $5 billion. That's the forecast. On the street, they're looking for $4.93 billion. And again, just looking at fourth quarter, let's go back to the quarter that was. Fourth quarter adjusted EBITDA, $154.1 million. That is better than the street estimate of $146.6 million. Fourth quarter revenue, that came in light, $1.59 billion versus a street estimate of $1.76 billion. And fourth quarter active riders, 29.2 million. That is bang in line with what the street was expecting. Investors not impressed. Stock down about 15% here in the aftermarket.
Okay, I'm looking at what's going on with Zillow Group. Shares bouncing around a bit. The company did meet estimates in terms of revenue, but the outlook is what everybody cares about. First quarter revenue set to be $700 million to $710 million. So It is a beat there in terms of what analysts wanted to see, 691.2. First quarter adjusted EBITDA will be 160 to 175 million. That is shy of what analysts wanted to see. They wanted to see 182.7 million. The company, once again, did beat on fourth quarter revenue. The company came in just shy when it came to rentals revenue. Fourth quarter residential revenue came in just above estimates, and fourth quarter mortgages revenue came in above estimates.
All right, guys, let's go back to Ford.
Shares down about 4.5%. Sorry. Go ahead,
forgive me. No. Ford bouncing around now, down just about 0.5% here. A little bit of commentary. We remain relentlessly focused on three key levers to improve margins, improvements in EVs, highly accretive anti-cyclical businesses that grow and change our risk profile, and next generation core products. So $1.5 billion of fiscal year 26 CapEx to be used to begin ramping Ford Energy. So look for some questions on the call, a little bit more context, if you will, on that. All right, guys, that's a wrap. A bunch of earnings. Ford now up about 0.6%. So as we said, bouncing around here. That is a wrap. Our cross-platform radio.
Just
TV.
looking at everything right now.
No.
There's a lot going on.
Did we miss anything?
No, we didn't. I'm just catching up. Sorry, go ahead.
It's a lot of earnings. We're not done yet.
No, we're not.
All right, but we are done with the closing bell. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Katie and Scarlett, of course, continuing there on the close on BTV, and Tim and I continuing on Bloomberg Business Week Daily right here on Bloomberg Radio. We will see you again, same time, same place tomorrow, guys.
And coming up, we'll take a look under the hood and examine those results out of Ford, including the impact of those rolled back U.S. environmental regulations on the automaker's top and bottom line. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifel. Let's take a look at where markets closed out on the day on this Tuesday. Kind of underwhelming when you take a look at the overall level. We're taking a look at individual movers here right now, though. So let's take a look at those because we did get those after hours earnings. Robinhood, you can see, was down about 10%, which is way more exciting than what we saw at the index level, with the S&P 500 down by about 0.3%. The NASDAQ 100 a little bit more, down about 0.6%. We did end up finishing near our lows of the day there. Meanwhile, you take a look at the Treasury market, a big rally after we got those retail sales coming in flat this morning, down about 6 basis points on your 10-year Treasury, and then Bitcoin down about 2% as well. But let me tell you about those movers. They're over here, so I'm going to go there right now. Robinhood down about 8%, 8 to 9% after hours. Zillow also off by about 3.6%. Ford, traders trying to decide what to do here. You can see that Ford shares are higher by about 0.8%. And sticking with Ford, let's bring Stephanie Valdez Streaty. She is Director of Industry Insights over at Cox Automotive. She joins us now. So Stephanie, I know you've had just a couple minutes to take a look through the Ford print here. It was a little bit messy when you think about the tariff hit, but give us your top line thoughts. What's your first reaction?
Yeah, I think just with Ford, right, they're taking the pain now. They have the $19.5 billion change in because of EV pullback, the tariffs. But I think when you look about going forward in 2026 in terms of their lineup, I think they're going to be well positioned. They're going to recover from the Novellis fire. They have a lot of hybrids in place. And if you look at 2025 sales, they were up 6%. And that was above the overall industry, which is up 2%. So in terms of performance sales, they did well. And now they're just having to adjust with all the EV rollbacks and trying to adjust with the Novellis fire as well.
Yeah, and it's interesting here to see the reception by the market. You know, you think about the 2025 that they're coming off of. What do you think will be the story for 2026, especially now that we have some of those EV charges, those announced EV charges behind this company?
Yeah, I think, you think about just the Maverick or just the 22% increase in hybrid sales, 2025 versus 2024. So I think they're going to continue to sell well with the hybrid. With the 150, which we all know is a top selling vehicle for them, over 880,000 units sold in 2025. And they're going to have the no longer Ford 150 Lightning as the E-Rev. And I think that's going to do well also because there's not going to be that fear of range anxiety. And we've also seen that they've pivoted from the battery to really focus on battery storage and for data centers and utilities. So I think that's also going to be something to watch for them in the upcoming years, as well as, we continue to see their Ford Pro business really shine.
Yeah, how should we be thinking about the energy business? I feel like it's maybe an underappreciated or under-talked about part of Ford's businesses here. But in the context of Ford overall, how are you thinking about that? How big of a driver could it eventually be for this company and for the stock?
Yeah, I think it's huge because if you think about AI, right, and that's going to cause a really big increase in the number of data centers needed to support that. And to support these data centers, we need battery storage, and that's going to really help with that. It's also going to help us stabilize the grid as we get more and more EVs on the road. So I think it's a really good investment. And I think Ford is, they pivoted at the right time when they saw the decline in EV sales happening in 2025.
And when it comes to the energy business, I mean, who are they competing with here? When it comes to this industry overall, I wonder how mature it is. I know that Tesla, of course, has an energy business as well, but who are the leaders at this point?
I think if you think about just, if you think typical battery makers, LG is a big one, SK On, but Tesla definitely. But I think the other thing about the battery storage is that it positions them also to pivot if they need those batteries for EVs, if they start to see that volume increase. Because I really think part of Ford is really trying to reduce costs, right? Provide more affordable vehicles. And they're doing that with their Universal E platform that's going to launch in a couple of years. And the more they can build out this vertical integration with the U.S. supply chain, which batteries is part of it, that's only going to help them reduce costs and be able to provide a more affordable vehicle.
I also want to talk about their relationship with some of the Chinese automakers as well. I know that that Ford has made an effort to partner with some of them. What do you make of that strategy, and what fruit might that bear?
Yeah, I think if you look at China, right, they've been exporting. They're pretty much everywhere in the world except the U.S. They're going to be able to go into Canada now. And I think that's going to be how they're going to get into the U.S., joint ventures. And I think they're excelled on their technology. They're very agile. They're quick to speed, scale. And I think Ford is wanting to partner, right, to leverage that and be able to bring some of that back to the U.S.
Meanwhile, we are counting down to the earnings call that's coming at 5 p.m. What would you want to hear from the executives at this juncture and, as you think about what we just learned in this report?
Yeah, I think I'm going to see how they're going to navigate around the tariffs, right? Because affordability is a huge, as you know, barrier for consumer adoption of any vehicle. And I'm also going to listen to what they have to say about their warranty costs, because that has been something that's been a big eating into their profit. So I'd like to hear what they're going to do to really reduce those overall expenses around warranty.
All right, Stephanie, really great to have you here to help us break down and think about these numbers. That is Stephanie Valdez Streaty, Director of Industry Insights over at Cox Automotive. Meanwhile, coming up, we're sticking with earnings, speaking with Hinge Health CEO Daniel Perez following results from the healthcare software company. That conversation up next. This is The Close. Take a look at shares of Hinge Health moving higher in after-hours trading following results from the healthcare software company that just dropped at about 4 p.m. Joining us now is Daniel Perez. He is co-founder and CEO of Hinge Health. Dan, it's great to have you back with us. Let's just walk through some of these numbers. The fourth quarter results, your revenue came in just above $170 million. That was ahead of estimates. When it comes to your first quarter forecast, your revenue forecast coming in above estimates as well, and then the year forecast, you see revenue between $732 million to $742 million as well, so a $10 million range here. Walk us through what you expect to drive that growth in revenue.
Well, first of all, just to put what we just did in 2025 in perspective, in the last decade, there has been less than 10 tech companies that have delivered over $500 million of revenue, 50% of revenue growth, and 30% free cash flow margin, and we're like number 10. So we feel very fortunate to be in such a lead company, and because of our investments in AI, we've been able to serve 50% more people in 2025 while keeping our care team costs flat. And on the customer side, we grew our reach to about 25 million people across 2,800 clients. But guess what? About 90% of Americans still don't have access to a digital physical therapy solution. So we're just getting started. It was a hell of a year, one for the record books. And, what's ahead? In 2026, we feel like we are executing on a generational opportunity to automate the world's largest services industry, which is healthcare. We're approaching $600 million of revenue for a US PT market valued at $60 billion. So we're just getting started in our core product, but we didn't come this far in automating PT to stop at PT. So even at, $60 billion, PT is just 1% of US healthcare spend. So we're hard at work at developing our next product to automate another slice of healthcare. We see this as a multi-decade journey, and 2026 is just another step on that journey.
Well, let's talk about AI, and there's a few different ways to get into it, of course. You think about what AI has done to software stocks over the past couple of weeks. You could make the case that Hinge's stock has also been caught up in that. And there's that existential threat, right, or that concern that AI is sort of going to really challenge the business models a lot of software companies. And Dan, I'm curious to hear, how you're thinking about that and how you plan to maybe future-proof Hinge Health here.
Great question, Katie. Look, since our founding, we've always had potential new entrant threats. Large tech companies, incumbent healthcare companies who are very, very large, or new startups. But we've thwarted those and thrived for over 11 years because our competitive advantages go well beyond just a code base. So first of all, our proprietary data, even if OpenAI and Gemini scrape the entire internet, they haven't conducted 100 million treatment sessions like we have. Simply put, we might have the most granular data set for musculoskeletal conditions in the entire world. Now, second is our distribution channels. We've spent a decade building deep relationships with health plans, PBMs, employers. That requires not just work on our end, but substantial work on their end. Thirdly, our product experience extends well beyond software to include hardware and in-person care as well. And when it comes to automating healthcare, you won't be able to do it with software alone. You're going to need hardware and in-person care. And fourthly, our clinical validation. You could build some apps in a day or a week, but to bring to market several 2-year studies validating clinical and financial outcomes, each still takes 2 years, no matter how much AI you have. And so healthcare is very much a trust and reputation business.
Well, it's interesting. I mean, if I take a look at your stock, you went public in May, of course, and you're kind of been on a round trip. You briefly traded below your IPO price. I have to imagine, if these after-hour gains stick, that you'll be back above that. But what do you think the market is missing specifically about your story, bearing in mind that there are some sector-wide factor here as well?
Yeah, look, I don't know how all of the IPOs are performing from 2025. Last I looked, I think we were still despite our round trip, the 4th best performing IPO of 2025, or tech IPO. So it's been a pretty tough year for tech IPOs, but there's vanishingly few tech companies with over 500 million of revenue, 50% revenue growth, and 30% free cash flow margin. And as the Oracle of Omaha said, in the short term, the market is a voting machine, but the long term, it's a weighing machine. So we're going to stay focused on delivering exceptional numbers, and in the long term, I think the market's going to catch up.
And Dan, we don't have much time left, but I do want to check in. When it comes to break-even profitability, the expectation was that 2026 was going to be the year. Is that still your expectation?
Well, look, when we IPO'd, we gave a long-term model that said, our aspiration was 30% free cash flow margin and 25% operating margin. We've already hit within 9 months our long-term free cash flow margin of 30%, which is pretty damn fast relative to other IPO companies. And we're at 20% non-GAAP operating margin in 2025. And it was a 28% non-GAAP operating margin in Q4. So there's, funky things with stock-based comp, but we are committed to GAAP profitability, so inclusive of stock-based comp. And our aim is to be GAAP profitable in the years ahead. But we're already on a non-GAAP basis. We're already, strongly profitable.
All right, Dan, really appreciate you taking the time after earnings. Of course, we'll let you hop to the call. That is Daniel Perez. He is co-founder and CEO of Hinge Health. Meanwhile, a quick check on some of the after-hours movers post-earnings. You can see that the lone gainer is Ford, up by about 1.5% here. Lyft really moving to the downside, down by more than 14%. Zillow, similar here, down about 5.3%. And Robinhood, it's actually off its lowest levels of the session, but still down by more than 6%. Now, still ahead, our healthcare earnings coverage continues with Philips CEO Roy Jakobs, who reveals where he sees health tech headed in the coming months. That conversation coming to you next. This is The Close on Bloomberg. Shares of Philips closing the day well in the green following results from the Dutch medical technology giant. I sat down with CEO Roy Jakobs earlier for his only U.S. dayside interview after those results. Here's part of that conversation.
We have some really exciting innovations in our uniquely differentiating platforms of imaging, monitoring, and our interventional platform, but also our personal health and consumer products are doing really well. Now, we have seen that coming back into strong order intake growth into 2025, where we closed the year with 6% order intake growth. Now, we will see that actually converting into growth into 26, where we guided for 3 to 4.5%, and that will sequentially then step up into the mid-single digit in the plan period. Also, on margins, we have been showing great margin expansion last year, despite the tariffs that we had to absorb. And we see a path where we continue to expand margins. We also given guidance for around 20 to 70 bips of improvement in 2026, again, including tariffs. That is on the back of more growth, so better operational yield. We continue our productivity program, and we launched another $1.5 billion of productivity for the coming 3 years. And also we see that our innovations are generating better margins because actually they provide better value to our customers.
Talk us through what you're expecting when it comes to the tariff front this year and what steps that you're taking to sort of mitigate some of that impact.
Yeah, great question. Tariffs indeed play into this. We already had tariffs to absorb $150 million to $200 million in 2025. We actually successfully did that and expanded our total group margin by 80 bips. So we put mitigation in place that actually also will help us in 2026. But 2026 will be the first full year of tariffs. We expect there will be around $250 to $300 million of impact in the year. But despite that impact, we will also grow our margins. Now, how do we do it? We invest further in North America. So we announced investments in Reidsville, plant that we have, which we will expand with ultrasound manufacturing on site. We'll also make sure that in the software services mix that we sell, we profit from actually the fact that they don't have tariffs. So you see in terms of what is the mix that you bring to market, you can actually generate sales and accelerate in your growth profile where actually tariffs are not hurting. And also we continue to work on our cost base. So as I said, we have a strong productivity plan. Part of that will also kind of be in effect in 2026. That is very much looking at cost competitiveness of our products. So actually we are costing down. Also, we are further around leaning out our central functions. And we continue to look for example, what AI can do in the productivity mix. So we are already coding 30% of what we do in enterprise informatics with the help of agents. So AI really is helping us to also become more efficient.
When it comes to, when you're talking about AI, I know that since you took the helm in 2022, that, one of the things that you did was put through thousands of job cuts. So when you think about unlocking some of the opportunities, some of the productivity that AI could bring, does that also involve shrinking headcount further here?
So actually AI, and the biggest opportunity for AI at Philips is what we do with AI for our customers. So actually, if you look to the innovations that we have launched also recently at RSNA, an AI-enabled imaging platform with the latest MR Blue Seal helium-free, an AI-enabled CT platform, also monitoring where AI is actually doing predictive work, so actually can predict whether there's deterioration of a patient, can even predict if there's a heart attack coming. So actually, we are embedding AI to support the workflows of our customers. That's actually yielding the biggest value creation for us and the biggest margin impact. We also use it to actually indeed make our organization more efficient. Now, that means we are leaning out processes with the help of AI so that they become faster and we can adapt faster to the changing realities around us. We also will continue with some leaning out of our functions, but this is not the big program that we had in the first phase, because there it was really about how we can become also more efficient with less staff. This time around is how you can do your activities more efficiently. In PH, the consumer business, 80% of marketing materials currently are made with the help of AI. That also makes that we can deploy the marketing in a much more efficient way in the market, where the platforms where consumers are looking for us. So We are looking for the specific opportunities where AI makes a difference, and that's also how it helps us to deliver on our targets.
I also do want to talk about China. You mentioned it previously. Your guide for China was pretty much flat. Talk us through what you're seeing when it comes to the Chinese market and whether or not we might eventually see a pickup in Chinese demand.
Yeah, great question. We also shared how we look geographically at the world in this new plan. As you mentioned earlier, the biggest growth anchor for us and engine is North America. We have more than 4 quarters of double-digit growth in North America in orders, so doing really well, supporting the health systems there that have clear demands for better care and to help more people. We also see the consumer demand actually being strong in the US. But then on the other side of the world, we see that China is stabilizing this year. We also expect some growth contribution, but we are realistic that this will be modest. And therefore, in our outlook, we are cautious on China, and we also are not depending on it. We are really driving Europe, some specific growth opportunities, for example, in Indonesia, where we actually had a massive interventional deal last year. India is doing really well. And as I said, North America is a very strong market for us, where we see real opportunities to support the healthcare systems, but also actually to give Sonicare and great one-blade solutions to our consumers.
And our thanks again to Philips CEO Roy Jakobs. Meanwhile, let's take a quick look at some of the other notable movers in after-hours trading. Of course, it's still earnings season. As you can see, Ford shares higher by about 1.3%. The company does expect profit to jump in 2026. They were saddled with a surprise tariff bill at the end of last year, but not too big of an impact expected there when it comes to 2026 profit. Meanwhile, Lyft now down 14.5%. Then you take a look at Mattel, the toy maker, down by 19%. Not very jolly. And then Cloudflare higher by about 6.5%. This is The Close on Bloomberg.
I do think 2026 should be the year of the IPO. And these things are cyclical. I mean, if you look at IPO volumes as a percentage of the market cap out there of the stock market, we've been well below that now for 4 years. And inevitably, like a flotation device coming back to the surface, that's the sort of thing that seems to be happening. So, yeah, I think the strength of the IPO market, earnings growth, and the success of some of these early IPOs, I think will lead to more in the coming year for sure.
And that was Blackstone's John Gray at the Wall Street Journal's Invest event on what he describes will be the year of the IPO. This as Bob's Furniture and Jennifer Garner's Once Upon a Farm deliver good news for consumer-focused companies looking to go public, raising $529 million in total. Edward Best, he is partner at Willkie, Farr, and Gallagher. He joins us now. Eddie, it's great to see you.
Good to see you.
So let's start there. The fact that, we did see 2 consumer companies go public within days of each other. That's the first time that we've seen 2 consumer firms actually complete IPOs in the same week since 2021. I wonder what you make of it, that, we're talking about this IPO rebound, and it's not just sort of the shiny tech companies. It's also, some of these more consumer-facing companies that we know and touch.
That's right. I think it's a wonderful signal to the market that it's not just the really sexy companies that we're all thinking about, but it's consumer companies, it's heavy industry companies, it's companies that support those. And we're seeing an awful lot of companies in all the different industries, which really bodes well for a larger rebound in the IPO market in 2026 and even into 2027.
Well, I'm wondering how the psychology works here. If you're in the pipeline, you're considering going and IPOing, you see Bob's Furniture IPO and be well received. Bob's Furniture, which has been around for decades. You think about Jersey Mike's Subs, for example, working on their own IPO. If someone in your broad industry goes public, has a warm reception, what does that mean for some of those other candidates?
So you really have to look at them and think, am I in the same place? So the things that you would think about are, what are my earnings? What are my revenues? Am I in the same place as they are? Do I need to go public? A lot of companies haven't gone public in a while because the private markets have been so robust. Do I need the capital to grow? Do I need the capital to do acquisitions? Do I want to sell the company out? The original investors want their money. So that's the first thing you look at. Why do I want to go public? And then success breeds success. So if there are a couple in your industry that go public, then there's an awful lot more focus on that. And the investment people will look at that and say, wow, this is great. There's just a lot of momentum. On the other hand, of course, if you have a couple in your industry that aren't doing well, then maybe you step aside and let some other folks go, wait till the market comes back.
So included in your checklist were things like revenue, for example, profits. And I feel like that differentiates this potential pickup we might see from 2021, for example, when you didn't necessarily need those things.
Absolutely. We've had cycles where we've had companies pre-revenue, pre-earnings go public, and we're not seeing that anymore. So healthcare has been a big focus for people now, and the healthcare companies that are beginning to come public, especially the ones dealing with obesity, oncology, are the companies that have revenues, are on the way towards earnings, and certainly have something that are in, far enough down in the drug trial that they're going to be developing more revenue. So it's less speculation, and we want to see companies that actually have businesses, have revenues, have earnings. They're real, I call them, they're grown-ups.
Mm-hmm. Well, let's talk about the fun stuff here. I don't know if this company would fall into that grown-up list, but I'm talking, of course, about SpaceX. Of course, SpaceX rumored and reported to be considering IPO in June or thereabouts, merging with XAI, so it's a deal story as well. I mean, if this company were to come public, we're talking about potentially a $1.25 trillion valuation. Right. Does that mean anything for the broader IPO market, or is that such a special situation that you can't really extrapolate out?
I'd say it certainly would be helpful. If it comes public and it does well, that's going to be helpful for other people. On the other hand, it is, I hesitate to say a unicorn because there's so many other unicorns, and it's a whole gaggle of unicorns. But if it does well, that's going to be fantastic. Interesting question will be comparing it, for example, to Facebook. Facebook was the first huge tech company to come, and that really opened the door for other large companies in the market to say, we're okay with valuations of companies in the $5 billion, $10 billion, $50 billion range. So something this large we've never seen before, but there's enough capacity out there. So I know people are worried that this company and one or two others could just soak up all the capacity, but I think there's plenty of capacity.
Well, I'm glad you brought that up because, there is the thinking out there, and we've had this conversation on The Close, that, SpaceX as an IPO, that's a must participate IPO. You can't afford not to be in there if you have the ability to be. But it sounds like you're pushing back a little bit, that this isn't necessarily going to crowd out some of the other companies.
I think that's right. It's, as you say, I think everybody wants to go in there. Interesting questions will be, what's the valuation? Because there aren't really any comparable companies. XAI would be the same. You haven't had OpenAI go public. You don't really have good comps. So what is the valuation? And so, yes, it's going to be a huge valuation, but is it worth $900 billion? Is it worth $1 trillion, and so, but people are all going to want to be in there. But you then have other companies that are fairly large, maybe a Databricks or a Stripe that people are looking at are fairly sizable too. I think people are going to come in to the SpaceX IPO, but I think they're all going to keep enough money to be able to go into some of the other hot ones.
And we have just about a minute left here. I'm wondering, the fact that we are talking about these companies potentially coming to the public market, SpaceX, OpenAI, maybe even a Stripe one day. Does this sort of, dispel the narrative or maybe take the sheen off a little bit that companies are staying private for longer? Or, maybe they'll actually come out a little bit sooner?
Well, these companies actually have stayed private a lot longer than anybody expected that they would. There's still, 100 unicorns that are private and will probably stay private because there's still a massive amount of private capital. But I think it's great to show that you can go public. It's going to be helpful, and it's going to also be important to see how they perform once they go public, and then what they're going to do with the proceeds. Are they going to go out and do acquisitions, and does it make sense for them to be public?
So private for longer, not private forever.
Right.
Necessarily. Eddie, it's great to see you.
Great to see you. Thanks for having me.
That is Eddie Best. He is a partner over at Willkie, Farr, and Gallagher. Meanwhile, still ahead, Pat McEnroe. He is one of the biggest voices in the world of tennis. He joins us with his predictions for the year ahead in that corner of sports. Don't go anywhere. This is The Close. Sports taking center stage this week with the Milan Olympics underway. Our own Romain Bostic is in Milan. He'll bring you an exclusive interview with Nike CEO Elliott Hill tomorrow. And last chance, Romain got a chance to catch up with another huge name in sports, tennis executive, broadcaster, and ESPN tennis analyst Patrick McEnroe. Here's part of that conversation.
We still have the most players in the top 100 of any country by a pretty good distance. You need a freak of nature to be number one in the world, to win majors. That's what Sinner is. That's what Alcaraz is. That's what Djokovic is, Rafael Nadal, Roger Federer, obviously. Serena Williams, was as well as a woman. But we have a whole host of young female players that are in the top 10 that have won majors, Coco Gauff being the leader of the pack. But because the game has become so physical, so athletic, unless you can compete with those top couple guys in all aspects of the game, you basically have no chance to win another major. So it's wrong to say that the program isn't successful, but it's right to say we haven't had that phenom, that freakish athlete play tennis in this country for a long time, as a male.
When you look at the sport of tennis as a business, is it healthy right now?
Oh, my goodness. I mean, the people coming through the gates at the Australian Open was like something I've never seen before. It was, record numbers by far. U.S. Open the same. All the majors have gotten bigger and bigger and bigger. It's the smaller tournaments, particularly in this country, that have suffered a little bit, partly because without the big American stars on the men's side, but it's also kind of the haves and the have-nots. The big events, the four majors, what they call the Masters Series events, those events have all become bigger, better, very fan-friendly. They don't get the huge numbers, TV numbers, that the other sports get, like football and basketball.
Right.
But as far as the numbers of attendance and sponsorship, the tennis is as healthy as it's ever been.
With regards to attracting eyeballs, in any sport, obviously there's the athleticism. People want to see greatness, but there's also the spectacle of it all, right? And we talk about Serena, obviously a fantastic athlete, but of course a lot of people tuned in her because they wanted to see, what outfit she was going to come out to the court with, or even back in your day, having loud, brash players, whether it was John McEnroe or a few other people, Jimmy Connors, and things like that. Do we need more of that? I guess I don't know how I put this. I guess just do we need more drama?
Personality. I think it helps, particularly in tennis because it's such an individual sport. Tennis is really about the individual, so it's also, of course, about the game. People like the game, but you're right. It's very much about the personalities driving the sport. So Serena, it was not just about her greatness on the court. It was about her overall persona. Same when it was my brother against Borg or Jimmy Connors. Arguably, you have some of those. Alcaraz, the guy just loves tennis, and he's a showman. I'm sitting there in the little commentary box right behind the court with my brother doing the match, and Alcaraz would come to our window a couple of times a match. During the match, he knew it was us sitting there, and he'd smile and he'd look at us and he'd laugh because he's entertaining not just us but the fans. So now, if he were American, that would move the needle in this country. And he is moving the needle around the globe. But if we're an American player doing that, if Francis Tiafoe were winning majors, he's got an amazing personality. Ben Shelton is another young guy. A lot of personality. And I think he's got a chance to win majors. But he lost to Sinner again in straight sets down in Australia. So it really takes a combination of all those things to move the needle from a viewership perspective in this country.
I am curious just about the dynamics between the men's side and the women's side of the sport. Obviously, with the big Grand Slam events, you kind of had that combination there. You mentioned sort of the secondary events, for lack of a better phrase. Is there an argument to maybe look at the ATP and WTA and say maybe for those events you should have more overlap between the two?
Well, you do have those in the big Masters events, which is the level just below the majors. So, and all those events are very healthy. But to your point, the ATP and the WTA has been looking for years now at coming together and being one tour. There's a lot of complications business-wise because for the most part, the men's tour, when it's on its own, is more successful financially than the women's tour when it's on its own. But when they're both together, I think it's better for all of tennis, and it's certainly better for viewers and attracting fans. But they have to come to an agreement financially to make that worthwhile. So that's been the sticking point. But definitely for the casual fan or for the fan to go to the BNP Paribas Open in Indian Wells, for example. I'll go there in a month out in the California desert. that's another type of event where people just want to be there. They get to see men and women, just like going to the U.S. Open. It's like a mini version of the U.S. Open. So whether that or not that happens in the long run remains to be seen. But tennis is really the only big-time sport where men and women, for the most part, in the big events, play on equal footing.
And our thanks to tennis executive, broadcaster, and ESPN tennis analyst Patrick McEnroe. Meanwhile, let's take a quick look at shares of Robinhood moving after hours, also putting pressure on Coinbase in the aftermarket session. When it comes to Robinhood specifically, their fourth quarter net revenue missed estimates. Their crypto business cooling a little bit there, which you can see is putting that pressure on Coinbase here. It's interesting, though. They did get a little bit of a lift from their prediction market. That's an area where we know that Robinhood and many others are pushing into right now. But you can see shares down by about 5.8%. We'll see how we open up tomorrow morning. And speaking of tomorrow, we'll speak with Robinhood CEO Vlad Tenev live in the close tomorrow at about 3 p.m. Eastern. You don't want to miss it. In terms of what else is happening over the next 24 hours, let's talk about it. Kraft Heinz, Shopify, and T-Mobile reporting earnings before market. That is definitely going to be interesting as we get deeper into some of those consumer-facing names. We're also going to hear from McDonald's, Cisco, Urban Outfitters, and AppLovin after the close there. It's interesting, actually. Ford CEO Jim Farley just joined the board of McDonald's. I don't think that will impact the report, though. Anyway, on the economic data front, at 8:30 a.m., it is that long-awaited jobs report for January. A little bit delayed. We'll get those figures finally tomorrow for January, as well as revisions. Definitely want to keep an eye on those. Will be market moving. We'll also see Romain Bosick in conversation exclusively with Nike CEO Elliott Hill. Certainly looking forward to that one. But that does it for us. Balance of Power is up next, and I hear that Kelly Lyons is back. Don't want to miss that one. This is Bloomberg.